As you see the individual income tax return tax form of 1040, you have taxpayers information about here, and then just under bottom of this page 1, it has the standard deduction amount that also showing the age and blindness, and then whether you are the dependent, and then your spouse information, etc. So as part of the your tax filing 1040, we are going to study for this class for standard deduction for this class. So you need to understand what is the standard deduction. The tax deduction allows individual and companies to subtract certain expenses from their taxable income, which reduced their overall tax bill. The tax system gives you a choice of adding up all of your deductible expenses and providing evidence of these expenses to the IRS upon request, or just simply deducting a flat amount and no question asked. The flat amount is called a standard deduction, as we see in the form, page 1, 1040 under the bottom. And the basic standard deduction ensures that all taxpayers have at least some income that is not subject to federal income tax. And standard deduction generally increases each year due to inflation. And you have the option of claiming the standard deduction or itemized deduction for your deductions, which we are going to study later on after this standard deduction. However, you can never claim both in the same year. You will find that many states also imposed on income tax will also allow you to claiming a similar type of deductions on your state income tax return. So for this current year, standard deduction amount, which is the flat amount of the $12,400 if you are filing as a single or married filing separately, or $18,650 if you are the head of a household, and then $24,800 if filing as a married filing jointly or qualifying widower. We studied all this filing status from the beginning of the class, and based on this filing status, standard deduction amount has the difference between these filing status. Also for the this standard deduction amount, as I mentioned previously, it will be adjusted by inflation. So it's going to be going up next year. So every year you need to check out the IRS website. So for also new standard deduction amount introduced, it's almost doubled from the you had the Tax Cut and then Job Act beginning in 2017. And it's about to expire December 31st, 2025. And also you have an additional standard deduction here, based on the age. If you are age of 65 years old or older, then you may increase your standard deduction by $1,650 if you are this single or head of household, and or your spouse is 65 years old or older, then you may increase your standard deduction by $1,300. If both you and your spouse are 65 years or older, then you may increase your standard deduction by $2,600. So additional standard deduction also based on your filing status. And also if you are the blindness, then if you are legally blind, then you may increase your standard deduction by $1,650 if filing status is the single or head of household. Then if you are the married filing jointly, or your spouse is blind, then you may increase your standard deduction up to 1,300, and you may increase your standard deduction by 2,600 if you both you and your spouse both are blind. Because due to the increase this standard deduction amount for every year, this is not you don't need to remember every this little detail or dollar amount, but at least you need to understand for the filing status. Then it depends on your filing status. This flat standard deduction amount is the increase. Then also there's a certain limitation for this standard deduction, and certain taxpayer are not entitled to the standard deduction if your filing status is married filing separately, and your spouse itemized deductions, then you may not claim the standard deduction. If one spouse itemized deduction, then the other spouse must itemize deduction in order to claim deductions. So when you or filing status, even though in the case of married filing separate and other spouse use the itemized deduction, then you have to follow the itemized deductions, not using the standard deduction. And also not all taxpayer qualify for the standard deduction. And non-resident alien and their spouses, married people filing separately whose spouse itemized, and trust and estate cannot take it and must itemize in order to claim their tax deductions from 1040 NR. So for the non-resident alien, then if you're filing the form 1040 NR, then you cannot take the itemized deduction. You have to use the standard deduction. So any also individual who files a return for the period of less than 12 months of the tax year, then his or her annual accounting period less than 12 months, then you are not able to eligible for the standard deduction. So you have to remember for the eligibility of who does not apply for this standard deduction for these three cases. For standard deduction versus itemized deduction that we are going to study later on, it is much simpler to claim the standard deduction than to itemized deduction. There's several itemized deductions that you need to also apply for this itemized deduction and IRS regulation. So the IRS recommends that you take the time to run the numbers to see which option gives you a bigger deduction. In particularly, you might consider itemized deduction if you made substantial charitable donations, or if you paid mortgage interest and property taxes on your home, or if you had a large amount of out-of-pocket medical expenses, or uninsured losses from the theft or casualty, and such as fire or natural disaster. For those amount you have more items to take a deduct, then you take the itemized deduction. But for the standard deduction, it's much simpler to take your tax expenses from your taxable income.